Welcome back. You're watching Capital Connection, broadcast live from London, Bahrain and Singapore. David Costa, the Dean at Robert Kennedy College, joins us now from Zurich with his thoughts on yesterday's trading session. I guess, Robert, would be a good place to start because we saw many of the banking stocks in Europe coming under considerable pressure, not just in Italy, but also in other parts of the Eurozone. How much of this do you think can be put down to any kind of rational analysis now? Because I know that you feel that some of the selling surrounding Italy has been overdone, but have we perhaps reached a point where the markets seem to be putting any rational argument about debt levels behind them and instead are looking at the overall lack of infrastructure that the Eurozone has to cope with this kind of thing?
A very good morning to you, Anna. Yes, I do think that here, in terms of rational reasons, there isn't really much to look at. What we see is fear is back into the market. And the reason why it's back into the market because they see the euro paralyzed, unable really to take a strong decision, which is what we need now, which might even include buying on the secondary market some of those Greek bonds. So I think Europe needs to move now before it's too late. The market is in fear, is in panic, and there is a sell-off throughout the board, across the board, without really looking at the fundamentals or which banks are well capitalized, which are not well capitalized, is across the board because of this loss of confidence throughout Europe.
David, this is Chloe. Regardless of what the fundamentals or what the books may tell you, I'm just wondering the velocity at which the sequence of events is happening. Isn't that a little bit alarming? Remember back in September 2008, Ben Bernanke and the policymakers in Europe failed to prevent that from stopping, and ultimately, don't we need to get a little bit more serious in terms of putting the stopgaps measures in place to prevent a bigger, much bigger fallout?
Absolutely. They wanted to see how quick contagion can move, and here we are. Here we see how fast it can move. It can be extremely fast, and it can have a far higher impact than helping a country like Greece or even finding a solution for some of the economies like Portugal and Ireland. So I think in this situation, we should be alert not to repeat the same mistake that happened with Lehman and saying, oh, well, a default wouldn't be as bad. A default would be extremely bad because we'll send a signal of insecurity across the board. So both institutional and private investors will not feel secure to hold almost any of the sovereign bond in Europe if there is a default.
Right, David. Now, a popular hedge would be gold for all this mess that we're seeing at the moment, but that is already close to lifetime highs. Do you really see an upside, and if so, where is it going?
It is very difficult because gold being priced in dollar and seeing the strength in dollars we see today, now gold starting to stabilize. We are at very high levels, at least in US dollar terms. And especially having weakness in the euro will signify in a way more strength on the gold. That said, if we look at the past 2 weeks where there have been a strong sell-off, gold position did do what they are supposed to do, which is provide a good edge. I would say broad commodity baskets, broad commodity indexes will probably have a better upside than just gold, but again, investors might decide to play other way. In both cases, I think that is still a good edge, probably not a good entry level now, but a good edge if things deteriorate further.
Is there a sense, do you think, Robert, that maybe the markets are being played here a little bit by somebody who's got an eye on the stress test results that are due out at the end of the week? Because, I mean, Mario Draghi, who is going to be the president of the European Central Bank and is a man who should know what's happening at the heart of the European banking system, he says the Italian banks are going to pass by some reasonable or decent margin. So if he's saying that, perhaps we can, perhaps we'll see some better news by the end of the week, and markets might stage some miraculous kind of recovery. How do you think these stress tests are going to play out?
I think the stress test will be largely positive. I don't expect any major surprise. The problem is that, as we have seen also last year, some of the stress tests have been criticized in terms of methodology. Italian banks particularly, I think they are pretty much undervalued because the business model in Italy for banks is not a very risky one. There is rarely some investment banking activity. So I think we might see a surprise toward the end of the week, but at the same time we need some quick decision from Europe to restabilize all the situation of sovereign debt. That's paramount. I don't think the stress test results alone will calm the markets.
David, thank you for joining us. David Costa, the Dean at Robert Kennedy College. European opening calls then look to be negative once again, so picking up on